Welcome to the Deep Dive. Today we're really getting into stablecoins. Now, you might think digital money is, super new, but actually the way we pay for stuff has been shifting for a while now. And if you're listening because you want to get stablecoins, really understand them, but quick, without your head spinning, well, you're in the right place.
Yeah, definitely. Our mission today is to give you that complete guide. We'll look at where they came from, how they actually function, the good stuff, the potential problems, and, what it all could mean for your everyday life.
Okay, so let's start with a little history then.
Yeah.
How did digital payments even become a thing? Because it wasn't overnight, right?
Well,
Checks, for instance. They went digital-ish way back.
They did, yeah. Around 2003, believe it or not.
Wow.
In the U.S., there was the Check 21 Act. It basically allowed banks to send digital images of checks, the data, instead of shipping the physical paper.
Right, instead of trucks full of paper checks crisscrossing the country.
Exactly. And it really sped up how fast checks cleared. Seems small now, but it was a big step.
It's interesting, isn't it? Taking something so traditional, like a paper check, and giving it that digital twist.
It really was a quiet, early move towards the totally digital payments we see now.
Okay, then jump ahead a bit. Mid-90s. That's when online banking started popping up.
Yeah, around 94, 95. Stanford Federal Credit Union is often mentioned as having the first proper online banking website, letting people manage their accounts through a web browser.
Wow. And then the bigger banks followed.
Oh, yeah. Wells Fargo, others got in. Presidential Bank even let you open an account entirely online.
Which must have seemed revolutionary back then.
Absolutely. Put your finances right there on your computer screen. Adoption was slow at first. People were maybe a bit wary.
Sure.
But eventually it just became normal, the standard way. Shows how powerful that digital convenience is.
Right. Okay, so that sets the stage. We're digitizing existing things.
Yeah.
But then we get into totally new forms of digital money, like cryptocurrencies. The European Banking Authority, the EBA, they have a definition for these virtual currencies, right?
They do. It's useful, basically. A digital representation of value. Crucially, not issued by a central bank, not necessarily tied to regular money, but you can use it to pay for things. And it can be transferred, stored, traded, all electronically.
So existing purely as digital code, a real break from the traditional system.
A complete break. And then you get Bitcoin and things like it. They introduce this idea of decentralized currencies, cryptocurrencies.
Where the trust isn't from a bank, but from math. From cryptography.
Essentially, yes. Really complex cryptography. Yeah. It enabled online transactions that were reliable, fast, and importantly, irreversible. Plus, no central controller and no built-in KYC, the know your customer checks banks have to do.
That lack of central control in KYC sounds like a double-edged sword.
It absolutely is. It offers, a certain kind of freedom, privacy maybe. But as some of our sources point out, it also makes cryptocurrencies attractive for, illicit activities.
Because they're harder to trace.
Exactly, the anonymity factor. Our source material on financial crime risks really highlights this. Crypto became sort of a go-to on the darknet because of that.
Right, which brings up that big question, doesn't it? How do you balance the potential good with preventing crime?
That's the puzzle regulators everywhere are still grappling with. A really tricky balance.
Okay, so we've moved from digital versions of old money systems to these new decentralized digital currencies. But early crypto, Bitcoin especially, was famous for its wild price swings, up and down like crazy.
Massively volatile, which made it really difficult to use for, buying a coffee or paying bills.
You would know what your money was worth from one day to the next.
Precisely. And that's the gap stablecoins aim to fill. That's where they come in.
Oh, okay. So stablecoins are designed to be stable, unlike the earlier cryptos.
Exactly. They're a type of cryptocurrency, but their key feature is that they're designed to maintain a stable value relative to something else. Usually it's a traditional fiat currency like the US dollar.
So they peg their value to the dollar or the euro or something like that.
That's the core idea, pegging the value to reduce those big price fluctuations.
Okay, makes sense. But how do they actually do that? How do they stay stable? Is it just magic?
Not quite magic, though sometimes it feels complex. There are a few main ways. For many stablecoins, especially those run by a central company, it's all about reserve management.
Reserves, meaning they hold actual dollars somewhere.
Yes. The issuer holds assets, often the currency they're pegged to, like US dollars in reserve. So for every digital stablecoin they issue, there's meant to be an equivalent value held back.
Like a digital IOU backed by real money.
Kind of, yeah. And one source mentions the idea of some issuers potentially holding these reserves at central banks.
Oh, really? For extra security?
That would be the thinking, yeah.
Yeah.
Extra security, uniformity, reliability, connecting it back to the traditional system in a way.
Okay, so reserves are key for many. What else?
Well, the technology allows for some interesting things. Stablecoins, like, say, USDC and DAI, they become composable within DeFi.
DeFi. Decentralized finance. What does composable mean there?
Think of it like Lego bricks. These stablecoins can be plugged into various decentralized financial applications for lending, borrowing, trading, all without a traditional bank in the middle.
So they're not just sitting there being stable, they're active parts of this new financial ecosystem.
That's a really important aspect, yes.
Huh?
They become building blocks for other things.
Okay, but how does that help keep the price at, say, exactly $1?
That's where something called arbitrage comes in. It's a market mechanism.
Arbitrage. Like traders taking advantage of small price differences.
Exactly. Imagine a stablecoin that's meant to be $1 dips slightly to 99 cents on an exchange. Arbitragers, these traders, can swoop in, buy it cheap at 99 cents. They might then redeem it with the issuer for a full dollar's worth of the reserve asset, or sell it on another exchange where it's closer to $1.
So their buying pushes the price back up towards $1.
Correct. And if it goes slightly above $1, say $1 or 1 cent, they can do the reverse, maybe get new coins from the issuer for $1 worth of assets and sell them for $1. That selling pressure pushes the price back down.
Interesting. So the market itself helps enforce the peg through these profit incentives.
That's the theory, yeah. It acts as a kind of self-correcting mechanism.
Are there other types? You mentioned reserves.
Right. There's another category worth mentioning, algorithmic stablecoins. Our source material doesn't dive deep into the mechanics, but the basic idea is they use complex algorithms and smart contracts computer code to automatically adjust the supply of the stablecoin to keep the price stable.
Instead of relying purely on reserves.
Exactly. Though these have faced significant challenges and collapses in the past, it's a more complex and sometimes riskier model.
Okay, I think I get the basic mechanics. So what are the actual benefits? Why should you, listening now, actually care about stablecoins?
Well, there are several potential upsides. For investors, particularly if you're in a country with high inflation where your local currency is losing value, stablecoins pegged to a stronger currency, like the dollar, could offer a way to hedge against that depreciation, to protect your savings digitally.
That makes a lot of sense. A digital safe haven, almost.
In a way, yes. Then for businesses, stablecoins could potentially streamline payments. Think about paying international suppliers. Using stablecoins might cut down on transaction fees and speed things up compared to the traditional banking system, which can be slow and costly for cross-border stuff.
So potentially cheaper and faster global trade for businesses all sizes.
That's one of the promises, yeah. It's not just for big finance. It could help everyday businesses too.
And what about just regular people sending money?
That's another big one, borderless transactions. The ability to send money globally, maybe without needing traditional bank accounts at both ends. Think about remittances, people sending money home to family overseas. Stablecoins could offer a cheaper, faster alternative to existing services that often take a big cut.
Right, cutting out some of the middlemen and their fees. It's sort of like the original crypto promise, but with that stable value.
You nailed it. That's a key distinction. And looking forward, because they're built on blockchain, they can be programmable. You can embed logic into them, integrate them with other digital tools.
Programmable money, what does that enable?
It opens the door for fintech innovation. New kinds of financial apps and services that we probably haven't even thought of yet, blending digital tech with the stability of traditional currency concepts.
This sounds potentially transformative.
Yeah.
Now, you mentioned different countries are approaching this differently. Who's really leaning in?
Our sources point to a few interesting examples. The UAE seems quite proactive. They were early with guidelines for crypto exchanges, and they even set up a dedicated regulator in Dubai, VARA, the Virtual Assets Regulatory Authority.
So they're actively building a framework.
Yeah, and they generally have high-tech adoption, pushing towards being a cashless society anyway, so it kind of fits their broader strategy.
What about Asia?
Hong Kong is another key one. They've updated their anti-money laundering laws, the AMLO, specifically to cover virtual asset businesses. Their main financial regulator, the SFC, oversees trading platforms, and the Hong Kong Monetary Authority is set to oversee stablecoin issuers specifically.
So, again, putting formal structures in place, trying to manage the risks while allowing innovation.
Seems that way, yes. Finding that balance.
How does that compare to, say, the U.S.?
The U.S. is interesting. It has a very mature fintech ecosystem, right? Lots of startups, established players, big tech, all involved. There's tons of competition, collaboration, but the focus often seems to be more on convenience, user experience, serving niche markets.
Rather than a fundamental shift using digital currencies at the core.
Perhaps. It's more about improving existing services, it seems, and notably, the U.S. hasn't yet issued full licenses for standalone, purely digital banks.
Interesting. What about large, fast-growing economies like India?
India's fintech growth has been explosive. They're moving rapidly towards almost ubiquitous cashless payments. Millions are using investment apps. There's a real embrace of digital finance happening there.
So huge adoption of digital tools.
Massive. And if you look at Africa, Nigeria often leads in fintech adoption stats. It shows digital finance is becoming really widespread.
It really paints a picture of a global landscape with very different speeds and approaches, doesn't it?
Absolutely. Some are actively regulating and encouraging. Others might be watching, maybe more cautious. Our sources don't list countries that are anti, but the varying levels of activity imply different priorities.
Okay, so bringing it back down to earth. How does this actually help the average person, the everyday worker? What's the practical takeaway for you listening?
Well, we touched on cross-border payments. That's probably one of the most direct benefits. If you send money internationally, stablecoins could mean doing it cheaper and faster than using Western Union or bank wires, which can have high fees and take days.
That would be a huge help for millions of people sending remittances home.
A massive difference, potentially. Also, think about access. In places with high mobile phone use but maybe less developed traditional banking, we mentioned Nigeria, Pakistan is another example with high fintech adoption. Stablecoins could offer easier access to digital payments.
Using the phone that's already in their pocket.
Exactly. It leverages existing technology to lower the barrier for participating in the digital economy, even without a traditional bank account sometimes.
Kind of leapfrogging the old infrastructure.
That's a good way to think about it. And then there's the future potential. The infrastructure built for stablecoins could enable whole new types of financial apps and services designed for everyday users, things we maybe can't even envision fully yet.
Like a platform for innovation that benefits consumers down the line.
That's the hope. But, and this is a big but, we absolutely have to talk about the risks.
Right. With any powerful new tech, there are downsides. What are the main worries with stablecoins?
Well, because they're borderless and somewhat decentralized, there's a significant risk of them being used for money laundering or terrorist financing.
The same features that offer benefits also create risks.
Exactly. The FATF, the Global Anti-Money Laundering Standard Setter, is already focused on this, bringing crypto asset service providers, CASPs, under their rules.
CASPs. Those are the exchanges and wallet providers.
Yes, the platforms people use to interact with crypto, including stablecoins. And related to that, sanctioned countries or individuals might try to use them to evade financial restrictions. Security is also huge. These platforms need really robust measures to protect users' funds and data from hackers. We've seen major hacks historically.
Yeah, cybersecurity is paramount.
Definitely. Then there's consumer awareness. Do people truly understand the risks? Many might not fully grasp how they work, or that stable doesn't always mean risk-free, making them vulnerable.
So education is crucial. What about the stability itself? Can they lose their peg?
That's a major risk, the risk of depegging. We've seen stablecoins, especially during market stress, broke away from their target value, sometimes dramatically.
So the promise of stability isn't ironclad.
Not always, no. There's also the risk that some might be under-collateralized, not actually holding enough reserves to back all the coins. And if demand falters, some designs could even resemble Ponzi schemes, relying on constant growth.
Wow. Okay. Any other major risks?
Well, vulnerabilities in the broader DeFi ecosystem where stablecoins are used can spill over. Weak KYC/AML controls on some platforms make illicit use easier. And of course, there's outright theft through hacking exchanges, plus the use of stablecoins and fraudulent investment schemes or market manipulation.
It really sounds like a space with incredible potential, but also significant dangers that need careful management and regulation.
That sums it up well. Exciting innovation, but proceed with caution and awareness.
Okay, let's tackle a really fundamental question.
Yeah.
What happens if the internet goes out? Do stablecoins just stop?
That's a really critical point. For almost all current stablecoin systems, the answer is pretty much yes. They rely fundamentally on internet connectivity for everything, making transactions, verifying them on the blockchain, checking balances.
So no internet, no stablecoin transactions.
In the vast majority of cases today, that's correct. Your digital wallet needs to connect to the network.
That seems like a massive limitation, especially for the idea of them being universally accessible, right? What about areas with spotty or no internet?
Exactly. It highlights a major barrier to truly global adoption in every corner of the world. It's a real challenge.
Are people working on offline solutions?
There's research and development in that area, yes, for offline digital payments in general. But based on our sources, it's not a core feature of how mainstream stablecoins function right now. They are intrinsically online phenomena today.
That reliance on connectivity is definitely something to keep front of mind when thinking about their future.
Absolutely fundamental.
Well, this has certainly been a deep dive. We've covered a huge amount of ground, from digitizing checks to the Wild West of early crypto, and now into the specifics of stablecoins, how they work, the potential upsides, the very real risks.
Yeah, we traced that evolution, looked at the mechanics of pegs and reserves, discussed the benefits for people and businesses, the global adoption picture, and the significant regulatory and security challenges.
And hopefully for you listening, we've managed to deliver on that promise, a thorough understanding without getting too bogged down in jargon. We hope this has brought some clarity.
So maybe a final thought to leave you with. As stablecoins keep evolving and regulators keep adapting and the tech itself keeps changing, how might they really reshape our basic understanding of money and our everyday transactions? Especially when you factor in those big ongoing challenges like security, like regulation, and like that fundamental need for internet access we just discussed.
What will it really take for them to become a truly trusted, universally accessible form of digital value?
Definitely something to keep thinking about, to keep exploring as this whole world of digital finance continues to unfold.